Welcome to the Treasury Update podcast presented by Strategic Treasurer, your source for interesting Treasury news, analysis, and insights in your car, at the gym, or wherever you decide to tune in. On this episode of the 2019 Outlook series, Craig Jeffery sits down with Executive Director Bob Leggett and Senior Portfolio Manager Michael Cha of Morgan Stanley to discuss the 2019 second quarter corporate investment outlook. They take a deeper look at the major shifts in short-term investing, the use of various instruments, and a number of macro shifts taking place in 2019 and beyond. Listen in to the discussion.
Welcome to the Treasury Update podcast. This is Craig Jeffery, and our session today is the 2019 second quarter corporate investment outlook. I'm here with two gentlemen from Morgan Stanley, Bob Leggett and Michael Cha. Let me give a quick statistical summary of Morgan Stanley for the few of you who may not know. Morgan Stanley is a global financial services firm. They cover investment banking, security management, wealth management, and investment management services. Their clients are corporations, governments, different institutions, and individuals. They have offices in over 40 countries, have over 55,000 employees, and their assets under management are about $470 billion. Welcome to the podcast, Bob and Michael.
Thank you. Thank you.
So Bob is the executive director of Morgan Stanley Investment Management. He's a liquidity strategist for their global liquidity business. He has over 25 years industry experience and joined Morgan Stanley in 2015. Michael Cha is the senior portfolio manager. He's part of Morgan Stanley's global liquidity team. He also has over 25 years of industry experience and joined Morgan Stanley back in 2008. But let's begin by taking a look back over the last couple of years and through the first quarter of 2019. We have seen several major shifts in short-term investing over this time and the use of different instruments. This has been brought about in part or a reflection of some regulation changes. We've seen money flowing into and out of different instrument types due to some different activity on the ground, if you will. What do you see as the primary causes for the changes that were out and in different instrument groups in 2018 and even in the beginning of 2019?
Thanks, Craig. I think there's really three themes that kind of capture the asset movement. The first one is, thinking back in 2018 was the environment. So you had an environment where volatility was increasing, particularly in the latter half of the year. It led to poor performance for fixed income and equity strategies. And you saw cash, if not the best, then one of the best performing asset classes last year. So I think the fact that you had more market volatility led to stronger flows into cash investments, and particularly money market funds. I would say the second theme was, the deposit beta environment. On the banking side, you had slower deposit growth, which, was driven by broader economic concerns and a Fed that, was starting to reduce the size of its balance sheet, which in theory slows money supply growth and ultimately deposit creation. You have a yield curve which has been flattening, which puts pressures on net interest margins. And in a flatter yield curve environment, banks are looking to protect their NIMs and are generally going to be less inclined to pass through rate increases to their deposits. Now, contrast that to kind of the money markets funds, and there you saw fund yields were broadly keeping pace with rising short-term interest rates. So effectively, the rates are being passed through almost immediately, and it's leading investors to evaluate, I think, the trade-offs between funds and deposits. And I would say in many cases, investors found that they were able to invest in a higher quality portfolio, i.e. government money market funds versus deposits, and earn a higher yield as well. And then I think the last thing that we saw in 2018 was a resurgence of demand for what we call here at Morgan Stanley conservative credit strategies. Conservative credit, to us, it's being packaged in a number of different product wrappers, including prime money market funds, conservative ultra-short duration bond funds, private placements, and separately managed accounts. So you saw in 2018 probably a little bit more than $100 billion come back into prime institutional and prime retail funds. But if you looked at that number just in isolation, I think that underestimates the demand. Because you had significant growth in conservative ultra short duration bond funds, probably somewhere in the neighborhood of $50 billion. And just to be clear, we define conservative ultra short bond funds as funds that really limit their investments to primarily money market eligible securities, limit their investments to investment grade only, and have generally shorter weighted average maturities, let's call it 3 months-ish, and weighted average lives approximately 6 months or less. So there was a lot of demand in that category as well. Just thinking about prime, I would say investors have come back into the space because they've seen limited NAV movement since reform. I think they recognize that liquidity in the products has been consistently high, more than the 30% prescribed liquidity which is required. The industry scale has returned. So if you look back to the fourth quarter of 2016, there was probably 5 funds that were over $5 billion. That number is probably closer to 13 to 14 today. And then lastly, I think investors have recognized that by moving into prime and out of other strategies, including government money market funds, there's real yield pickup. And you're able to pick up, somewhere between 20 and 30 basis points of extra yield and still satisfy primary objectives that liquidity investors have, which is principal preservation and liquidity.
What was that gap, back in 2016 or a year prior to the flow back in?
Yeah, I think that gap was probably closer to 10 to 15 basis points.
Now, I was going to say that the historical average on the spread between prime and government money market funds over a long period of time, I know it can be compressed, it can widen, but it's probably about 20 basis points.
Okay, so you see it moving back towards the historical norms and therefore money's flowing back in as part of that?
That's kind of where we are right now. We are at about 20 basis points of yield pickup between prime and government money market funds. I think the most recent developments in the marketplace that Bob alluded to, and something that we will talk about shortly as far as some of the macro shifts that we've seen recently, may actually bode to setting up a scenario where those spreads compress. And when you have a situation like that, I guess the big question for users of money market funds as well as managers alike is, what will be the behavior of the client base if that spread does start to compress? One of the things that I think is clear, there are some clients that will require some self-imposed spread between a government money market fund and a prime money market fund. But I think there will be a big swath of investors that are comfortable with the prime money market fund as an asset class and as a product type. And if they can get a decent pickup, maybe 10 basis points, they're still going to remain in the fund.
Yeah, thanks for that summary of the key reasons money is flowing back into some of these other fund types like prime funds. How much of it do you think is driven by the increase in rates and how much of it is based upon the volatility in other instruments, or is it just hard to allocate the different weightings of those factors?
No, I think they're all very important. I don't know if it's necessary to weight those factors. I mean, clearly, you would think that if there is increased volatility, that if investors want to park their money and wait out for a direction in the market with more conviction, that a money market fund is a good place to park their cash. But as we alluded to earlier, throughout this rate cycle for the last couple of years, it was a completely different proposition when you were talking about a zero interest rate environment where cash was not returning much of anything. And from a policy perspective, that is by design, right? I mean, you don't want people to sit on cash. You want people to go and deploy capital. And that's why rates are, set at those levels by the central banks. And the amount of accommodation that's built into the system is to incentivize folks to put capital to work. with the rising rate environment that we've seen and all the higher policy rate adjustments, as we alluded to earlier, cash is now an asset class again and to consider. So if you just look back even in this past year, and I know some of the questions have references multiple years, but just this past year, if you look at the performance of cash compared to some of the other strategies out there, it's done extraordinarily well. And so it is an attractive investment, even notwithstanding some of the other dynamics that we described as far as market volatility and the safe haven for folks' capital.
Yeah, excellent. So, just shifting from the backward look to looking forward as we look deeper into 2019, as we finish the first quarter and move into the second quarter, there have been a number of pretty major shifts that are taking place, some of which you commented on. I was wondering if you could expand on the context of some of the investment decisions in light of some of the things that happened in December and some of the guidance provided by the Fed recently. And maybe what you could do is give us an inventory of some of those macro events, and we can jump into any of them in detail that makes sense.
Sure. I mean, I think, the point that we're making the major shift has been the outlook and the policy shift of the FOMC. I think up until the December meeting, when they actually did tighten by 25 basis points, it almost felt like the market was on automatic pilot, and Fed policy for the near term was also on automatic pilot. And when I say automatic pilot, I'm saying that it was the major quarterly policy meetings where I think what they were touting as well as what the market anticipated were largely in line. But again, with the volatility that we saw at the end of the year and financial conditions tightening up dramatically, a series of really kind of, bad news, if you will, for the marketplace, the Fed has completely pivoted, and now the outlook looks dramatically different than what they were advertising, if you will, back in December. Since that time, clearly there have been developments, whether it's in Europe or whether it's in China, both those central banks, and the outlook was revised downward. The central bank in Europe, the ECB, has also, at their most recent meeting, described how the outlook was negative and needed to perhaps inject a little more accommodation. So they are going to come out with they announced that they were going to come out with another financing package for banks to incentivize lending. So, if you pull all that together with the trade tensions that's out there as the trade negotiations between the U.S. and China are being negotiated, as well as the uncertainty around Brexit, it seems like the Fed had enough meat on the bone, if you will, to take a pause. And that has been their message. And the messaging is that they will remain patient and see how things develop. One of the things that they absolutely would want to do is to make sure that the economic recovery that we're seeing in this country is sustainable. And it seems like that is taking a paramount or a priority, if you will, over their other two mandates, which is employment and price stability. The last meeting, what we did see was the Fed clearly stating that fact. They want to support the sustainability of the recovery, but they also acknowledge that, look, we are part of a large global economy. And so therefore we can't be, insensitive of developments that obviously would impact us in the future.
Yeah, that's interesting. Let me ask you a couple of questions on a few of those. So let's start with the Fed's plan to raise interest rates. They moved down their autopilot and the number of times they expected to raise it. That guidance you gave in terms of patience, is there, I think the expectation is what, no expectation of increased interest rates from the Fed now? Is that pretty standard?
Yeah, so if you look at the most recent median dot plot out of the Fed, they revised it to no policy adjustments for the remainder of 2019 and one interest rate hike in 2020.
Yeah, definitely more muted than 6 months ago, right?
Oh, yeah. If 6 months ago, we were talking about three rate hikes in 2019, the terminal rate for 2019 back between September and December was calling for 3 rate hikes in 2019.
It's interesting just the magnitude and how quickly the market recast its expectations around Fed policy, as Mike noted.
Are you referring to like December, what occurred and how quickly the adjustment followed?
Exactly. I mean, if you looked at curves, in the beginning of December, end of November, beginning of December, there was at least one rate hike priced in for 2019. Now we find ourselves with one ease being priced into the market.
Now that one ease is basically priced in by, again, as Bob said, the market. It's not what the Fed's dot plot would indicate, but clearly there seems to be somewhat of a dislocation between what the market is pricing in and what the Fed has said vis-a-vis their dot plots. But, that phenomenon, I would just add, is not completely surprising because throughout this whole rising rate cycle, if you will, with the Fed adjusting policy rates higher, the market has lagged, generally speaking, as we approach those Fed meetings. And so not until, right up against those Fed meetings have we seen the market fully price in those hikes. But there was a lag, certainly.
I am definitely going to add the Fed dot plot phrase into my lexicon and try to use it a couple times in the next week. So that's helpful on a number of fronts. But with the interest rate, so as you look at the yield curve, normally it's upwardly sloping to account for the time value of money. The longer you have it held, the higher interest rate you should have. Now, you talked about it flattening. What's its current trajectory?
Well, so I guess we should take a slight step backwards if we're going to talk about, quote unquote, the curve. The curve is going to be a byproduct of a variety of different assumptions and expectations, one of which is interest rates and the path of interest rates going forward. And clearly, the Fed is saying that there's no interest rate adjustments, so the path of interest rates should be basically neutral, absolutely flat, if you just look at what the Fed is pricing in. But as Bob alluded to earlier, if you look at basically something like the Fed's funds futures or the OIS curve, that is actually pricing in some percentage of probability of a rate cut because it is inverted. So from a pure expectation of what we think or what the market perceives to be the path of interest rates, at best it should be flat. But like I said, the market is pricing in some type of easing because it is inverted. If you move away from the interest rate variable, you need to take into consideration other factors like liquidity. That clearly is a consideration, as well as credit. So if we anticipate that, clearly the liquidity premium is going to be worth something, so you should have a natural positive slope associated with the liquidity premium. And then from a credit perspective, obviously the longer bet you make on credit, albeit our higher curve is out to a year, but it could be meaningful, and that should also contribute to the fact that the curve should be positively sloped. If you boil all that together right now, the curve is very flat again. I think the outlook on the interest rate part is actually kind of overshadowing or taking a dominant role as far as the variables that I laid out.
There's a few things on quantitative tightening. I wondered if that's something you wanted to comment on in terms of the Fed moving to quantitative tightening and doing it essentially. I think Powell indicated it was on autopilot, or maybe that was just a description of it, to the tune of about $50 billion a month put back in the market. Now, that's being moderated as well. It's no longer on autopilot. I know the European Central Bank and the Bank of Japan are not in quantitative tightening, not unwinding the asset purchases that they've made. Any comments on that in terms of how that's, impacting elements and, end rates?
Well, again, I think it's a part of the dovish sentiment, and it plays right into their outlook right now for, basically the position of trying to remain accommodative to maintain the sustainability of the recovery. The balance sheet normalization is definitely going to end. I mean, that announcement was made. It's going to end at the end of September. But even perhaps another detail, though, that shouldn't be overlooked is that they're going to start tapering in May. So they're going to reduce the amount that they've been normalizing the balance sheet by half, and it's going to basically end at the end of September. So one of the things that Powell mentioned in his press conference as well was just how large the Fed's balance sheet will be in the near term. And once it's all said and done, the projection, and supported by his own comments, was something north of just $3.5 trillion. As far as its impact on the outlook for rates, obviously the fact that they stopped normalizing and they've indicated that they're going to be on hold as far as adjusting policy rates in the near term. Certainly over the next 2 years, only one policy adjustment indicated by the dot plot. You've seen what's happened to the yield curve. So both those actions, the announcement about the balance sheet normalization and when that's going to end, as well as the outlook for policy rate increases, have clearly put downward pressure on rates.
Anything else on balance sheet normalization or other macro impacts that you want to comment on?
The only thing that I think we can mention about what the ECB had announced is the introduction of a TLTRO number 3. This is the financing package for banks that I alluded to earlier in the conversation, and the details of which we are still waiting for. But again, the introduction of that is an accommodative move. So again, it coincides, like I said earlier, that we have seen downward projections for economic growth, not just in places like China, but certainly in ECB for Europe, and the ECB certainly has done something about it.
The one thing I might add is, we talked about the implications of uncertainty leading to stronger demand for cash as an asset class. I would say just the uncertainties in the global economy are leading to central banks to either pause or potentially ease monetary policy further. You think about kind of what's happening in England, there kind of the strategy around Brexit is to just put more time on the clock, but as they put more time on the clock, that creates a level of uncertainty for the economy, and it's going to lead to potentially the central bank to be on the sidelines a little bit longer. China, they've effectively been easing, they've been adding liquidity to the market in recognition that their economy is slowing. So they're doing a number of things, from devaluing the yen to increasing the reserve requirements to adding fiscal stimulus and investment incentives and tax cuts. All this in recognition that, hey, their economy is slowing, but collectively, all this uncertainty around the globe, I think, is leading to central banks to say, hey, wait, let's see how things play out here. There's a lot of uncertainty in this environment, and we'd rather be safer and take our time raising rates rather than doing it in kind of a rushed manner.
Thanks for some of those details around the globe, too. Now, as we look at what are some of the implications, or what should treasurers of global multinationals, heads of finance, and treasurers of institutes of higher education or different industries, what should they be looking to do throughout the rest of 2019 to be able to respond to or adapt different changes that are planned or otherwise? What's a good course forward? What should they be doing or looking to do?
Yeah, that's a great question. And it's interesting, right? Because I think what all of us have lived through, at least through the last 10 years, has been a period of disruption and industry transformation, right? And that's changing the dynamics of the liquidity or the funding markets. Thinking about just the forces of disruption over the last 10 years, you've had negative and zero interest rates, you've had quantitative easing, you've had banking reform, you've had repatriation, and you've had money market fund reform. All this is leading to changes in how banks have funded themselves, as well as the utility of different product types. So I think what we're telling our clients more than anything is that you need to be flexible or adaptable. You need to think about your investment policies being flexible and adaptable so that they'll be better positioned to capitalize on market dislocations and to pivot, to allow companies to pivot to strategies that will still emphasize principal protection or liquidity, but might offer better risk and or returns for investors. And just to give you a couple of examples, there's a lot of clients whose policies just contemplate, deposits in government money market funds. It might make sense to look at other strategies such as prime or conservative ultra short duration bond funds. Are there other strategies that make sense? And I think there's strategies that focus on credit transformation that could be appropriate. And what I mean by that is there are security types that offer the same exposure to an issuer. However, that security is collateralized rather than unsecured. So if you're comfortable having the risk to the issuer and you can earn a slightly higher yield and receive the benefits of collateralization, that's something that you might want to consider. You're doing it you're getting exposure to that issuer in a safer form and potentially with a higher yield. We also just tell investors that cash is likely to remain an asset class that's going to be important to your portfolio, particularly given the shape of the yield curve and the uncertainty we've been talking about in the marketplace. So are there strategies that could be a complement or a substitute to what you're doing today? And I think you need to consider those. But the important thing is, you need to adapt and evolve because the markets are adapting and evolving.
Based on the expectation on interest rates and some of these other economic factors, do you expect funds to continue to flow into institutional money market funds or prime money market funds throughout the rest of this year?
Yeah, I think just to support the fact that, our assertion that cash is now an asset class again, we have seen pretty healthy inflows into certainly the prime money market funds. And prime money market funds have always been kind of discussed with our client base as kind of more strategic or core cash. The daily in and out or daily cash needs should be supported by their use of government money market funds. So it kind of correlates with, they enjoy the higher yields. And again, at this point, look, the prognosis is that there won't be any rate hikes. So even if rates stay where they are, I think from a conservative investment standpoint or a place to park your cash safely and earn the kind of yield that you're earning right now makes a lot of sense.
Excellent. I want to thank both of you for your comments as we look at the 2019 corporate investment outlook, really Q2 and beyond. Any final thoughts?
I don't know if we have any final thoughts. The questions that we're asking ourselves are, what products I think are our clients looking to, as the markets adapt and evolve. And it's really difficult to create a product that's differentiated in the marketplace. We do see a lot more interest in bond funds as a complement to other liquidity strategies. The separate account world, I know that we talked a little bit in the past about this, but separate account strategies, unclear from my perspective on kind of the growth in those strategies. So if you think about historical growth, I think it was driven by the rate environment and where that cash was located. Right, so if you look at kind of the 20 largest multinational corporations, they had more than $1 trillion of liquidity on their balance sheet. That number has been coming down. And if that number has been coming down, then kind of maybe the growth of separate accounts is either going to be flat or slightly down. So, what we try to do is think about solutions that are appropriate for our clients. And, we'll continue to kind of think about what those solutions might be, but it's a challenging exercise.
Bob and Michael, thank you for joining me on the Treasury Update podcast.
Thank you. We appreciate it.
You've reached the end of another episode of the Treasury Update podcast. Be sure to follow Strategic Treasurer on LinkedIn. Just search for Strategic Treasurer. This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.